$3 trillion in AI infrastructure, a surprise cloud computing business on the horizon, and a stock that Wall Street analysts say is still 34% undervalued. Today we are breaking down Meta Platforms and why it might be your next cloud provider. Meta stock jumped over 3% today after launching an enterprise-grade AI business agent. This allows companies to automate core operations directly through Meta's platforms. It proves Meta is no longer just a digital ad company. It is building a powerful second revenue engine. Even bigger news came from the annual shareholder meeting. CEO Mark Zuckerberg announced that launching a cloud computing service is definitely on the table. Meta is already being approached weekly by companies wanting to buy its API services and computing capacity. If Meta enters the cloud, it will directly challenge Amazon, Microsoft, and Google. Plus, income investors can look forward to a quarterly dividend of 52.5 cents per share, payable on June 25th. Let us look at the numbers. Meta currently trades around $615.88. With a trailing EPS of $27.52, its trailing PV is 21.7 times. More importantly, its forward PV drops to just 18.2 times. For a company growing this fast, that is incredibly cheap compared to its historical average. The PEG ratio, which measures valuation against earnings growth, sits at an attractive 0.88. Anything under 1.0 signals that a stock is undervalued relative to its growth. With an RSI of 55.36, the stock is in perfectly neutral territory. Conservative fair value estimates from Simply Wall ST start at $717, while Guru Focus targets $797. That represents a 16 to 29% upside just to reach baseline fair value. Wall Street consensus is overwhelmingly bullish. Out of 64 analysts polled by S&P Global, the consensus is a strong buy with an average price target of $826.75. Rosenblatt holds the highest target at $1,015. RBC Capital is at $810, and Arete Research recently upgraded Meta to a buy with a $735 target, praising its flexible cost structure. Even Bank of America maintains a buy with a $710 target. The main risk to watch is capital expenditure. Meta raised its 2026 capex outlook to between $125 and $145 billion for AI infrastructure. If this massive spending does not translate into immediate revenue, it could pressure margins. However, with Q1 revenue reaching $56.3 billion and operating margins above 41%, the financials remain rock solid. The next major catalyst is the Q2 earnings report on July 29th, with an expected revenue of over $60 billion. Between a PEG ratio below 1, heavy institutional buying, and the massive cloud computing wildcard, Meta is trading at a significant discount. Please hit the subscribe and notification buttons. See you in the next one. Thanks for watching. This video is educational and informational only, not a financial advice.